How does the Fed's decision to pause short-term interest rate hikes impact consumers? One example, with the Fed pausing rate hikes, consumers in the market to purchase a home shouldn't worry if their pre-approved rate expires later this month that their next rate will be higher. The reason why is the Fed funds rate influences the prime mortgage rates offered by banks to their most creditworthy clients. With the Fed deciding to pause short-term rate hikes, the question I'm receiving from investors is, what does that mean for July? And what does that mean for rate hikes for the remainder of this year? Although the May core inflation numbers were lower than anticipated, there will need to be a significant change in the economy for the Fed to cut rates. Based on economic data such as employment, wages, economic output, the probability that the Fed will enact a dovish monetary policy before the end of the year is unlikely with how entrenched inflation is in our economy. With the Fed pausing short-term interest rate hikes, the question is a recession still likely at this point? Although there are signs of a softening consumer demand, it remains relatively strong. The unemployment rate for May increased to 3.7%, which is still considered historically low. However, there are indications of a slowdown in economic growth. If the Fed decides to raise rates in July in response to June's economic data, the likelihood of a recession will increase. The Fed's target inflation rate is 2%, which may be difficult to achieve given current inflation levels without additional hikes. How does the Fed's decision to pause short-term interest rate hikes impact savings accounts, CDs, personal loans, and credit card debt? Well, clients have had an excellent opportunity to save money in the past year. The T-bill, considered the risk-free rate for stock market investors, has remained consistently above 4%. However, it's been a challenging time for those with credit card debt or who require a personal loan. The recent Federal Reserve rate pause will not have a significant impact, positively or negatively, on rates for savings or debt instruments.